Good evening, everyone. It's November 12th, and welcome back to the Investor's Guide to Thriving. Well, it looks like Larry was right. Stephen and I owe him $500. It almost went the other way, but it appears Trump did in fact lose. I can't take away from Larry that he's now called 2 elections correctly in a row when all the pollsters got it mostly wrong. But I figured I was hedged because I didn't really like Donald Trump as a person, and now hopefully Larry will stop talking about him so much in these webinars. So what's next for the markets and the economy then? You'll be able to find out each Thursday at 7 o'clock Eastern Time as we continue this series through December 3rd. In between episodes of Berman's Call, which has now returned to its usual time slot, Mondays at 11 a.m. Eastern Time. We hope you can also make time to help Larry and I support childhood leukemia research at the Sick Kids Foundation and Alzheimer's and dementia research at the Baycrest Foundation. These are 2 causes that are very near and dear to Larry and I. They've both helped our family members of ours, which really opened our eyes to how important the work that they is doing. So for those of you who have made donations, thank you very much. If you would like to make a donation, please use the links in the survey you'll receive after the event. This is how we're able to track and match your donations. That survey is also your gateway to access the webinar replay. It'll arrive in your email tomorrow morning. Tell us how we did and you'll get a link to access all the above and submit questions for next webinar. As always, we're thrilled to bring you the Investor's Guide to Thriving, and that's thanks in large part to the support of our excellent partners. This includes National Bank Direct Brokerage. They not only support this series, but also Larry's Investor 101 videos on YouTube. This is a great resource for those of you who are still getting to know investing, but more likely, given that our audience is probably more in the intermediate to advanced category, these are great to forward to your family members or younger people in your family who want to get a head start on investing. Speaking of a head start on investing, here tonight to give you an overview of their state-of-the-art investor platform and how you can get 200 free trades is Iris Nye from National Bank Direct Brokerage.
Thank you, Jared. Hi, everyone. My name is Iris, and I'm the Business Development Manager at National Bank Direct Brokerage. I am super excited to be here today to present to you our some of the research section that we offer at National. Okay, so basically the disclaimer is saying that at National Bank Direct Brokerage, you are responsible for your own investment decisions, and we are not here to give you any advice or any recommendations. Okay, so today we are going to take a look at some of the research that we offer at NBDB, National Bank Direct Brokerage. Okay, on the next slide here, you can see that there are 4 major buttons that are always at the top right corner. So you see the buy, sell, the transfer button, and get a quote. So let's say you want to do some research on a particular, on a specific stock. You go to get a quote, right? You enter the symbol or the company name, then it brings you to this page that you're looking at right now. Okay, you can see the middle box, the yellow box, it highlights the summary of the different research that we have. So National Bank Financial says it's sector performing, right? Morningstar gives it a 4 stars out of 5. So the more stars means the more undervalued the stock is. And you also get analyst recommendations. So based on 15 analysts, it's an overweight rating, right? And then technical summary. So this is based on Recognia. So Recognia is a computer analysis system. So it gives you the market sentiment. If you click on any of that research, it brings you to the analysis tab, which is showing on this screen right here. So National Bank Financial, you can see who the analyst is, the latest report, the target price. Same thing for Morningstar, right? You can see the target price, the analyst, and the date of the reports. If you want to read into more detail, you can click on the analyst report at Morningstar or the company snapshot from National Bank Financial. So these are the 2 research that we provide. And if you go back to the previous slide, here you can see at the bottom, you can see the analyst recommendations, right? So based on 15 analysts, you can see how many of them think that it's a buy rating, right? So 8 of them think it's a buy rating, 1 overweight, 6 hold. And the little brackets next to the rating, so buy is a 1, score of 1, overweight score of 1.5, hold 2, etc. So the lower the score, the better buy the stock is. And you can compare the score from 3 months ago, and you can also see the target price from these analysts. So give you a quick, validation on, whether you should buy the stock or not. So on this next slide, you can see that under our research tab, you can find more research, more reports. Okay, so we'll take a look at the publications first, which shows on the next slide. So under the publications, what I really like about this section here is the stock select list, which gives you some of the suggestions from Morningstar and NBF. So every month, this list is going to be updated. So you see an updated list every single month from Morningstar and NBF. So let's say you're looking for stocks that in Canada, the blue chip companies in Canada. You just want to take a look, what's good to invest this month, right? So this slide gives you an idea of how the report looks like. So Morningstar, you see the consider buying list, and then the star rating, the target price, if there's any dividends for these stocks, right? And then the National Bank Financial Select List, you can see under each sector, what are the suggested companies, right? And the price and the target price. I mean, it's really easy to follow reports. It just gives you an idea, what to invest, what to look for every single month. Okay. And we also have our own ETF research team. Okay. We have many different ETF reports. And this is just one example of many reports that we provide. So this report shows you, the trends, what are people investing in right now? And we also provide, ETF model portfolios. So if you want to build your own portfolio with ETFs and you don't know where to start, you can take a look at our ETF section as well. So that's done with the publication. And this one here, it's the company coverage. So let's say you want to look for a report with a 5-star Morningstar rating. You can use this filter and filter out the reports that you want to see. Okay, and if you want to keep, stay updated on any rating or target price changes, you can go to the rating and target price changes section, where you can see, okay, so previous target price, for example, for DR is $4.25. Now the target price is $4.50. Okay, so this is the list view. You can also look at the grid view, which shows on the next slide. So this one, I personally like this view better, because I can see, green means, the target price has increased, the star rating, how the star rating has changed, etc. So it's a really good way to keep yourself updated on the different changes in star rating and target price. Okay. And on the next section, if you want to get some updates on the economy, on the industry, we also provide reports as well. And on the next slide, you can see the report on a particular stock. So this is Air Canada. So National Bank Financial is on the left-hand side, right? So you can see the analysis for Air Canada on the left-hand side from NBF, and on the right-hand side, you can see the report from Morningstar. Okay, of course, this just shows you the first page. So for Morningstar, there are 10 pages of report. If you really want to read into the detail, really want to understand more about the company, this is a really good place for you to take a look at. Okay, so if you want to filter, so there are some reports that you want to find. Instead of going through each document one by one, you can use our filter to filter out the research that you want. So for example, stocks, NBF reports, and then you can also choose the date of the reports as well. So that can help you, find the report that you want a lot easier. And on the next slide here, you can see it shows one of our dividend stock select list from National Bank Financial. So not only will you find a dividend paying, a list for all the good dividend paying stocks from Morningstar, you also find it from NBF, from National Bank Financial. So that's just a very quick overview of some of the research that we provide. Now let's talk about our pricing. We are the only brokerage that offer 0 commission on all of the Canadian and US ETFs. So for those of you who likes trading on ETFs, this is the best platform, best place for you, because you don't have to pay any transaction fees. But keep in mind, one of the conditions is that you have to trade over 100 shares. Okay, how about for stocks? Okay, on the next slide, you will see the pricing packages for stocks. Now, regular clients pay about $9.95 per transaction, right? That's the industry average, right? But if you are a bank, national bank client, meaning if you have a bank account with us, you only need to pay $6.95. If you are a young investor, or you know anyone who is a young investor under the age of 31, we have the most aggressive, we have the best offer for young investors. So you can see they get 10 free trades every year. And even if they're done with the 10 free trades, they only need to pay $4.95. So that's a lot cheaper compared to regular clients. And they don't have to worry about the annual fee either. Okay, so they can start with 100, 200, it doesn't matter, because we are there to help the young investors to start getting into the market, to start learning about investments with no fees. And then on the first column is active traders. If you trade more than 100 times per quarter, the trading fee is only 95 cents. Okay, so this is also very aggressive, as well as a good offer for active investors. And if you are opening an account before December 31st, this is for a brand new client to NBDB. So if you open the account before December 31st, you enter the promo code, you get 200 free transactions for your first year. And these transactions can include stocks, options, and ETFs. For those of you who trade a lot of options, especially with a lot of contracts, this is an amazing deal for you, because you get 200 trades for free, because option trades can be quite expensive sometimes. So if you have any questions, feel free to reach out to our customer service or myself. You can get my contact through Stephen, and this presentation will be sent to you after the webinar today. Thank you so much, everyone, for listening, and again, I'm very happy to be here today. I'll pass the ball back to BMO. Thank you.
Thanks very much, Iris. Well, we're very grateful for the partnership we've had with BMO ETFs since 2009. They're our original and premier sponsor of the Investor's Guide to Thriving. BMO continues to lead the Canadian ETF industry, not just in sales, but in innovation, offering an ever-increasing array of ETF tools to help you grow your portfolio and target your investing to the precise country, asset class, and even sector that you want exposure to. Here to show you what's possible from the capital of Canada's energy sector is Rob Butler, Director with BMO ETFs.
Jared, I appreciate the introduction. For those of you that follow sectors, energy in particular, what an exciting week it's been in the market, to say the least. And I actually think it's appropriate based on what we've experienced over the last 4 business days, up and down, with particular sectors taking shape, with potential vaccines coming down the pipeline and so forth. So really the premise of today's presentation, I'm going to try to give you a bit of a guide as to what I want you thinking about as it applies to exchange traded funds and sectors, and why we have clients using ETFs to get the exposure that they're looking for in particular situations. For those of you that are not familiar with BMO, I have a quick slide up here. Well, you're familiar with BMO, but in terms of the ETF space, we've had a great run over the last decade. We're going into our 11th season now. We have over 110 different ETFs that you could buy from us at any given day. These all trade on the TSX, so the Canadian marketplace, and it's been exciting to be a part of it. And I think you'll recognize, anyone that's familiar with the exchange traded fund business, there's over almost 40 different providers you can work with any given day in Canada now. So the due diligence that's required on your part to make sure you're working with a partner that makes sense and can deliver on the commitment that we make in each product line, I think it's incredibly important. So we'll touch upon that a little bit as well. In terms of sectors and why I think it's topical, and I will say that based on asset flows, we've seen more appetite for those that are investing in particular, I say sectors, but industries as well. And you'll notice as we go through the presentation, we really do offer both. We kind of bucket it all in the sector-based types of ETFs, but some of them are more industry-based, and I think you'll see that come through. So it's very topical, as I mentioned. I think those that are looking at behavior of some of these exchange-traded funds based on one of economic outlook, interest rates, volatility on any given day. I'm not suggesting it's appropriate for everybody, but for those that run a really strong core portfolio and want to either complement what it is that they do day to day with that core position, the ETF business and the way you can access a sector for such a low cost, transparent wrapper, it's very, very compelling. And I'm going to try to highlight that for you here. You look at this one slide where we've got Amazon highlighted, and there may have been a stock split recently, so it may not cost $3,000 as of today, but just the cost of entry to make an investment in a particular company within a sector can be cost prohibitive. And really, depending on the size and scale of the assets that you're working with, you might find that desirable to invest in Amazon, but it just doesn't make sense when you're buying 1, 2, or 3 units of a particular stock. And I think National just highlighted that, where you need to buy at least 100 individual positions or units to be able to trade for free. So in the case of Amazon in this scenario, it just might not make sense for every type of client. So to do that, why not look at an ETF that tracks the industry that Amazon is effectively captured in? And interestingly, you might own a benchmark and Amazon's going to find itself in there as well. So you might be able to double up in your core position and your sector position. But I think that's something that is required for you to just get comfortable with what it is that you're buying and what's underneath the hood. To be able to find an industry or a sector tilt, being able to buy the NASDAQ, being able to buy a communication ETF, in fact, I mean, we have it that targeted now, as do most other providers, that you can be very, very specific in your exposure. So one thing that you'll notice in a lot of different products, if it doesn't specify, then it's worth looking under the hood to determine whether or not the weighting or the exposure to the securities are one of cap weighted or market cap weighted, or whether they're equal weighted. We've used the REIT sector that you'll see in the matrix below here. We've taken ourselves, we've taken iShares, and then Vanguard, and kind of highlighted what each of the equivalent products are in that particular category from us. And all we're trying to highlight here is, just because it says REITs in the title, or for any matter, technology, whatever it might be, do pay attention to how the basket is weighted. For the most part, BMO in the Canadian market, that is, we would use an equally weighted approach to investing. And really the benefits as we see them to you is you're far more diversified in terms of any single stock over concentration or security risk. And you can kind of see that where it says the top 5 holdings across ZRE, XRE, and VRE, where in the case of our equally weighted product, you don't see any more than roughly 4.8 to 5.4% weighting at any given time to any one particular name. And this was actually quite dramatic 8 or 9 years ago, when I think if you bought the market cap version of the product that we have in front of us here, you would have been buying 1 or 2 names that represented almost 30 to 40% of the basket. And all of a sudden, the idea of buying an ETF starts to lose its advantage, where if you're getting exposure to 1 or 2 names, yet you're buying an ETF with 15 different securities within it, it may make more sense to just buy the security itself outright. So that's the premise or the idea behind equally weighted approach to investing, where you're getting really good diversification across a sector or a particular industry, and normally we'll include that in the name of the ETF. This is how we lay it out in our roadmap. For those of you that have seen our roadmap, I think it's one of the better tools, especially the digital version, where you can pull it up in a PDF. You can click on any ticker amongst the 110 that you could get access to, and it will take you directly to that product page. What I love about it, when I'm in the field or doing a presentation, no longer do I have to Google a particular ETF. I'm no longer competing for the top 10 ETFs that are paying for marketing dollars to come up at the top of that search function. Just use the roadmap or the dashboard from our dashboard. And for those of you that have not been there, BMO ETFs.ca, and in the top left, you'll see something called a roadmap, and you can save that. We update it regularly, and if it's a hyperlink from your computer, it'll always update the data automatically. What I love about the layout of the sectors or industries that you have in front of you, we've done one of 3 things. It may not seem intuitive at first, but I'll just highlight those across the top band of the products that we've listed here tend to be a little bit more defensive in nature. You'll see that coming through in utilities, REITs potentially, infrastructure. And it's not always the case. It doesn't mean that they're not going to have any volatility, only that they tend to be a little bit more defensive. And then you'll see near the bottom of the page some of the energy names, maybe US or Canadian banks. They tend to be more cyclical, where they're going to do better if the economy is doing well. And what's unique about this is you can kind of tilt between the two. And I've got a lot of clients that are very dialed in terms of picking market cycles where we find ourselves in the market cycle, and being able to tilt or rotate into different sectors based on where they see us at any given time. You'll also notice geographically, from left to right, we've gone more Canadian to the far left, and then entirely global on the far right. And then the third piece that may not stand out, and I do want to highlight, is anytime you see multiple tickers in one box, and you'll see ZUH, ZHU, ZUB, ZBK, kind of near the middle of the page there. All we're highlighting there is that you can buy these investments hedged or unhedged. And for those of you that don't follow the currency piece, unhedged means you're buying it in Canadian dollars, but you're tracking a US asset. So you are subject to movement in the US Canadian currency, which can be good or bad depending on your view. If you don't like the idea of having to think about the currency piece, you can buy the hedged version. And you'll notice, even if we don't offer 2 series of any one product, we will specify in the name of the product whether or not we've hedged it or not. And on the next slide, what I like about the illustration that they provided, and I kind of talked about this, where we are in any one economic cycle and rotating between different types of products. I mean, anybody that was paying attention to, let's call it the US banks or REITs in the last 4 business days, I mean, US banks had a wonderful run 2 trading days ago, where we're talking about 8 to 12%, depending on the type of product you were looking at. And for that reason, it's the purity of that ETF. It does exactly what it's supposed to do. It's going to track that underlying security, and one for one, it's going to replicate the value in the secondary market that you and I can buy or sell. So what I love about it is I'm not having to make a call in the case of US banks on JP Morgan or on Goldman Sachs. I don't necessarily have a strong bias toward any one name in the US banking sector. I just know that from a personal perspective, I feel like there may be some upside opportunity in that they're still trading down 28, 30% from their January highs, which I love. And then to even take the conversation a step further, you can buy the US banks from us in a long only series, but you could also buy a covered call version. So that's something I'm not going to get into today, but recognize that a number of the sectors that we offer, we do offer a similar series where we have a covered call or a written strategy where we increase the total income to you, the unit holder. So again, a totally different conversation, but know that the sectors can pop up in different categories of our product line. And all the pie charts intending to show you, sorry, on that last slide, is in different parts of the cycle, recessionary periods, early recoveries. These are the types of sectors you would ideally want exposure to. And I'm not pretending it's easy to make that call. Many of you might work with an active manager as your core investment piece, but you may have a bias toward the Canadian banks, or maybe you're a little bit more conservative and you're not sure what interest rates are going to do. Therefore, you want a little bit more utility exposure. Again, the tools are there for you and to make that actual call. So moving forward to the slide, I call this the jelly bean chart. And you can take this one of two ways. Either you find it very overwhelming and you're not sure what to make of it. Ideally, what I'm trying to highlight here is no one sector performs well every given year. So the idea of, well, I'm just going to buy tech and I'm going to sit on it for 20 years. I'm not suggesting it won't do well, but it will come with a lot of volatility, or it could come with a lot of volatility year in and year out. And you just need to be comfortable with that. But I think what's unique about this jelly bean chart is you can look at the different industries and sectors and just look at in a weaker year, what does the drawdown risk look like versus what the upside potential looks like in a strong year. And I always think that people look to 08, 09 to do that. I think we're also going to be having an opportunity to really highlight how some of these securities have performed or held up in this most current year, which is kind of interesting. Now, the one nuance I'll suggest is that the recovery, quote unquote, in the market's been a lot quicker than what you might have found back in 08, 09 to this point. Nobody knows how that plays out moving forward, but I think at this point, it's amazing. If you looked at something that you bought at the beginning of the year or year to date, and then looked at it today, depending on what it is, it may not look terrible, even though we've gone through a lot of stress in the markets, and certain sectors have come under a lot of pressure. And again, for those of you in Ontario and Quebec, I recognize that there's current shutdowns taking place. So just depending on the subjectivity of where you live and a lot of unknowns in place. So very interesting to think that you can make calls on the market based on what we're seeing around us and pick a particular sector to kind of highlight that opportunity for you. The last thing, I didn't highlight it here, but what was supposed to be represented was that actual dashboard I referenced. So BMO ETFs.ca. The other piece that you'll be able to find there, there you go, is actually a great screening criteria. And what's really unique about this, in the case of the sector conversation that we're having, if there's a particular security that you want exposure to, but instead of deductively trying to figure out what ETF holds that particular security, this is reverse lookup. So you can put in Apple or Amazon, as we talked about on the front page, and then it'll give you a list of all the ETFs that we produce that have exposure to that particular security. I think that's a great time-saving tool, and you just go to tools on that dashboard. So I'll encourage you to take a look at that. It's called the screener criteria. And if you have any questions about that, feel free to email me or phone me after the presentation today, and I can help you work through that. We're now going to shift gears. We have the co-founder of ETF Capital Management. He is very well represented on his Monday Now TV show. It's moving back to Monday time slot on BNN, the BERMAN'S call. He is incredibly influential in both fundamental and technical analysis, having earned both of those designations simultaneously, which a lot of investment advisors and portfolio managers have not done, maybe ever, if not a very limited number have. Also, a professor of behavioral finance. He may not accept the professor title, but I'm going to give it to him. And that's a big part of what he does in his business management and how he invests money on behalf of clients. He's very much looking at risk and beta at all times, and he's doing this through the use of both his proprietary technical analysis and the fundamental skills that he's developed over the last 30 years in investment management. On the BMO shelf, there's 3 different ways you can get access to Larry Berman. It's through his growth, balanced, or dividend mandate. The premise behind all of them is risk management at all times. And with that, I'm going to hand the stage over to Larry Berman.
Thanks so much, Rob. Hopefully everybody can hear me and see me. I'm not sure if I'm having internet problems, but I had some volume come in and out. So Steve, if you're listening, just make sure my internet connection is solid here, and be on the alert if I fade out for some reason. In this work from home period that we're in, I still recommend shorting Rogers and Bell as an internet providers anyways. I'll leave it at that. Okay, so, a lot of questions have come in about gold. I wanted to reiterate and talk about gold and why I'm so bullish and it remains my favorite asset class. I want to look at some of the areas in the next few weeks that we're going to experience or likely to experience some tax loss selling, and some of the areas where there might be some profit taking kicking in as for some opportunities. But and then I want to talk about the vaccine a little bit and Pfizer and how to play that a little bit, and then to Q&A. So getting right into it, here's a very interesting model. When you look at what moves gold, and they call the fundamentals of gold, obviously it's buying and selling, and the biggest demand for gold is from jewelry. And I'm a big buyer of gold for jewelry purposes. I find a lot of utility. So that's about half. You've got central banks, you've got a little bit of industrial demand, and then another big swing factor is investment demand. And so, as prices rise over time, the jewelry demand comes down because it gets a bit more unaffordable for many. But the investment demand tends to pick up, central bank demand tends to pick up. But the main factors when you look at correlation and what moves markets, you're looking at a scatter plot here. And what we're looking at on the model is the relationship between a 5-week price change of gold and the model factors of real rates, so interest rates less inflation, and then currency. And you've probably heard that gold moves on currency and real rates. So you certainly have heard me talk about it. The other factor, which is less important, is risk on, risk off. The first two are dominating. Number one, by far, is the real interest rate, or the competition that gold has from other investment assets, and namely other risk-free assets. But because gold yields nothing, it tends to lose out if you can get other assets. I remember as an analyst a lot earlier in my career, in fact, as the tech bubble was breaking in the early 2000s, I was looking at these long-term gold charts because gold had peaked, if many remember, in the late 1980s. And basically for the whole decade of the 90s was under consolidation. Central banks were saying, why are we holding this as a reserve? It yields us nothing. We can go buy government bonds, and as interest rates fall, make money on that. And so a lot of money came out of central bank assets. They were dumping gold like crazy, and it was just a bad decade. But as we got into the tech bubble coming unglued, you were seeing all these monster mega year base patterns develop in gold stocks. And I started to notice this again a couple of years ago, and we looked at valuation of these gold names, and we kept saying, gold at $1,100, $1,200, coming off $1,900 earlier in the decade, these are now trading at multi-year and decade valuation levels. And I really started getting bullish a couple of years ago at those levels, with the full anticipation that interest rates were not going to be able to go up and real rates would remain very, very low. And that has clearly been a major driving factor. So if you look at the last few years, you can see the base pattern I'm talking about. So the blue line on top is the spot gold price, and the red line is the real 10-year interest rate. So it's the 10-year US Treasury yield minus US CPI. And we got really bullish mid to late 2018. You can go back and watch some of those Berman Call episodes back then when we were really positive. But the headwind at that time was that the US dollar index, which is the green line, was actually rising. And we know that falling US dollar tends to be bullish for gold, but it really wasn't in a big way in 2017. You can see the US dollar falling, the green line going down, the euro strengthening, and gold improving a little bit, coming off the lows from late 2016 under 1200, rallied up to about 1350, but came back to about 1250. At the same time, generally speaking, the dollar was weakening, but gold really did nothing there. It wasn't until real interest rates, as the Fed started to raise rates, that put pressure on interest rates. So you had positive real rates. So when that red line falls, real rates are going up. So as nominal yields rise, inflation stable, real rates are higher. So you get a real return on your money buying a bond. But as real rates started to fall, as the Fed started to raise rates and kill the economy, bond markets started rallying, inflation picked up a little bit, and all of a sudden you start to have negative real rates. So by mid 2019, you can see that red line got up to zero, and gold started to break out of this pattern. Once we got into the early part of 2020, before COVID, you can see the real rates started to go negative again. We got the COVID shock when the world shut down, and you saw these risk parity funds that use gold and interest rates as an asset class deleverage, and over a couple of weeks, the crazy volatility that we saw in fixed income markets and in gold, and the gold equities, the ETF, got cut in half. And I reiterated at that point that the story on why gold is a strong buy has not changed. And I want to reiterate that story again today. Don't worry about the noise. The last few months, as real interest rates got to minus 1%, you can see that. The scale is inverted there on the chart. And gold bullion, consolidated. So you had a massive run. You had a breakout to all-time highs. We got a consolidation back to the breakout. At the same time, real yields started to decline. Today, for the first time in weeks, real yields started to turn negative again as the bond supply from yesterday and today is out of the way, and bonds started to rally. Real rates started to go a little bit negative, and gold starts responding. Now, notice what we have as a positive right now is a declining dollar. So you have negative real rates and a declining dollar. These are two very, very bullish catalysts for the outlook for gold. And again, it remains my favorite asset class. Gold equities remain very, very cheap. So this week on Berman's Call, we talked about this and we highlighted why analysts our targets are not as high, because they think the price of gold is unsustainable at these levels. The average gold equity analyst thinks 2 years from now, gold's going to be back at 1,700. Well, it will be if you believe that bond yields are going to go up and we're going to normalize. But if you're in my camp and you believe the only way the world is working and we get economic growth is government spending bags of money and central banks monetizing that, then gold and negative real rates, for years to come. So I'm very, very bullish on it. Don't let the volatility shake you out. You can trade them around a little bit, but you got to be a dip buyer. Everything here is firing on all cylinders, and I think gold has the next couple years can be fantastic. But if something comes along and we get the Fed backs off, the Fed says we're not buying bonds anymore, and all of a sudden the US 10 years it moves to 2%, game's over for gold. Now, as that's happening, gold's going to sell off aggressively. So, is there a line in the sand? Is there a point where, well, if we see the US 10-year back up above 1% and the Fed doesn't come in, Powell makes a speech or whatever and says, we don't like interest rates going up here, we're going to buy them, we're going to be more aggressive. If you don't see that, that would be a signal that the central bank's willing to let longer-term bond interest rates go up. But they can't, because if that happens, mom and pop buying houses slows down considerably. And we need those financing rates out to 10 years to stay very, very low so the US economy can keep going, and frankly, the world economy. There is so much debt out there that every 100 basis points in interest rates going up costs the US government 1% of GDP in extra interest rate cost. So when the cost of or the amount of debt outstanding is 100% or more of GDP, and the US economies call it $20 trillion for rounding, there's now 25 trillion in debt. The Fed owns 5 of it. So net, the interest payment, so at 1%, the interest payment's $200 billion. At 2%, the interest payment's $400 billion. $200 billion is 1% of GDP. That money's up in smoke. So they have to borrow more and more and more, and you get into this debt cycle. We can't get out of this, folks. It's impossible to grow out of it. And I was staggered today by one of the banks came out and said that they think the Fed's going to be raising interest rates. The economy's going to recover. Everyone's going back to work. We're going to recover. COVID will go away at some point. The jobs will come back. But as we learned in the last rate hike cycle, they can't raise them because the stock market will have a fit, especially at the valuations we're at today. So keep buying dips on gold. You'll be well rewarded. Okay, so let's look at some tax trade ideas. So what I did on my Bloomberg terminal yesterday was I did a filter for the top groups and the bottom groups. So what's been doing well? Obviously, internet retailers, that's Amazon. The wireless, tech hardware, application software, Microsoft falls in that group. Copper, gold. Okay, so these are the groups that have been doing very, very well. Rob talked about sectors tonight. Well, here's the ones that haven't done well. Okay, hotels and resorts, REITs, right? Obviously. Retail REITs, shopping malls, for example. Oil and gas, airlines. Oil and gas exploration, amongst the worst. Oil and gas equipment manufacturers. So these are the areas where in the next couple of weeks, we're probably going to get some pretty significant tax loss selling. But a lot of these, when things reflate and we get back to normalization, vaccine second half of next year and so forth, a lot of these stocks are going to come back big. And so there's a tradable opportunity. I'm not bullish on energy. I think we're on the downside of the curve and every rally should ultimately be sold. But these things are so depressed now, notwithstanding the recent volatility, that you got to be a buyer of dips in a lot of these areas. So let's have a look. So there's an ETF that trades the airline sector. This is Global Airlines. ETF ticker is JETS. So as the vaccine news from Pfizer came out earlier this week, you saw the massive gap up above the 200-day average big base pattern. So I think the next few months are still going to be tenuous in terms of recovery, and we're going to get a pullback to that 200-day average. So for those of you out there in the next couple of weeks, have a look for that. If you want to play the sector, this is the way to do it, to the JETS ETF. Okay, so there's one idea for you. Let's look at another one. So this is oil drillers and gas drillers. XOP is the ETF. And again, looking at it, remember negative prices in April. So we've got this base pattern. I think at a very minimum, the exploration and production, XOP companies, rally back to the 70 mark sometime by mid next year. So there's a great tradable rally here, and we're now in a buy dips mode for this sector. Okay, the technical pattern, 200-day average is going to be some resistance. We should get a bit of a pullback here, but again, we're now buying dips. We have this nice base pattern playing out here. REITs, and specifically, I took the US, the big Vanguard US REIT VNQ, and I opened it up to the performers, and I want to highlight Simon Property Group, number 10. So that is the biggest single mall operating REIT in the US. And so as this corrected yesterday and today, actually yesterday it was up. You can see the broad ETF was up 32 cents. Today they were down, but the retail REITs got crushed. So Simon Property Group, 73.41. Not sure where it closed today, but it was weaker. Again, look at Simon Property Group. Look at that base pattern. Look at what it did when they think the vaccine, we're going to go back to normal. And we're not going back to normal anytime soon. But the pullbacks now are probably buying opportunities in a sector like this. There's going to be bankruptcies. They got to repurpose a lot of these malls. Many of these stores aren't coming back, but other entrepreneurs will be there and things will open up again. So again, here's another great tax loss idea in the coming weeks that you might want to have a look at. Another idea for a tax trade. So here's 3 ways to play the S&P 500. You've got SPY, everyone knows the S&P 500 spider. You've got SPY value, so the value names. You have SPY growth. The difference between growth and value, I've talked about it in weeks past in this part of the series and showed some charts on this, but it's incredible what growth has done relative to value. And if you're looking to play the reflation trade, money's going to come out of the growth names. If you look at just the FANG names and you say, okay, let's go back to pre-COVID, you're talking about $2 trillion in valuation coming out of the FANG names, the Microsofts, the Amazons that have done tremendous this year, and going back into these value names that haven't done great this year. But you take 2 trillion from that white line and put that 2 trillion into the orange line, and that orange line is up 10% more and the white line is down 10%, and boom, they meet in the middle, right back with the S&P. So we're going to get a period of mean reversion next year where value outperforms growth. Doesn't mean you don't want to buy the dip in the growth stocks, but for now, as we think about recovery and reflation, that's the trade. I'm doing a lot of that in my portfolios. So here's what that trade looks like for the last 4 years. So SPYG, SPYV, the yellow green line combination at the bottom is the percentage performance. So it starts at 1, both neutral, again, going back to 2015, so 5 years. And you can see that value in 2016 outperformed growth into early 20. But Trump was elected and the growth trade took off, okay? And growth outperformed value, but really post-COVID, right? Q1 this year, 2020, incredible, the difference between them. And now we're going to get some mean reversion, and it could be 30, 40, 50% difference in return between the growth and the value ETF. So you can buy the market, you can buy SPY, and SPY itself might be up a little bit, down a little bit, but it's the difference in the stocks within the index that we're going to see the mean reversion, or we're going to likely see the mean reversion. And this is one of the things I'm playing. Here's another stock we actually just bought today with an option, Pfizer. So Pfizer a few days ago reported the vaccine results. The stock popped pre-market 14%. Apparently, the CEO of the company sold 70% of his holdings into that pop on Monday. Apparently, it was something that was pre-planned, that he had an outstanding order that if it gets above 40, he's going to sell, something like that. So when insiders sell, usually that's bad for the stock. But if you look at the last 5 years, Pfizer below 35 to 30 has been a buy, and it's been a sell above 40. It's a reliable dividend-paying stock that if you can buy it at 35 or lower, is going to pay you 4.5%, 5%, and you can write calls above 40 and sell it and earn premium. It's a great, stable, yielding stock, not a lot of volatility, and ultimately it's also a play on the vaccine. So I wrote some puts. I'm looking to buy it at around 37. I wrote puts for next week. If it's below 37, I'm going to be long. If it's not, I'm going to keep writing puts until I get to buy Pfizer. And once I own it, I'm going to write calls somewhere above 40 and earn extra income. So in the idea of the ZPay world, where we're trying to earn stable yield with less volatility, here's yet another idea of how to do that. And one of the things that I'm doing in my portfolios now. And again, just reiterating the problem with markets and why we need to think out of the box is because when you look at your typical balanced portfolio, 60-40 stocks to bonds, your guaranteed yield is 1.37, which is less than the rate of inflation. So you must have growth in bonds and in equities to make money investing in these markets. It's the most complex problem that the investment industry faces going forward, is to generate that real yield for investors with less volatility. And hence why for years now I've nicknamed my portfolio the Sleep at Night portfolios, because that's what we attempt to do. Notwithstanding the last 3 or 4 months of the performance in ZZZD, for example, which has been awful. We're earning the yield of around 5% now, but because gold is my biggest position and gold stocks are down about 20%, that's been weighing on the portfolio, because we've had 50% of the portfolio in the US dollar at an average of 136, and we're now at 131. There's another 3 or 4% there. So, we've lost probably 7% in the portfolio being hedged for no growth, while clipping that 5% yield. And because what we're long isn't working out well these days, but it doesn't mean it's not going to work well. I think gold, again, is still going to be a tremendous ballast to portfolios on a lower risk perspective, but also potential huge growth in the next few years. So big problem. And I've said for the whole year where we've put out this list, I love all these things because Biden won, but didn't win a mandate for the Green New Deal. The clean energy stocks are no longer a buy short term. We're going to have to wait for a much more material correction in a lot of these things. So I'm off the clean energy for now, but all these tech areas, tech software, very overbought. I talked about growth coming out. So we just have to be patient for the growth trade to play out and actually now think more about these value names and these areas that I've talked a little bit about tonight and given you some ideas in that regard. So into the Q&A period now, and this week we'll start with the ones who have sent in. So getting a question asked about Zipper. So Zipper is the ladder preferred ETF, and I actually just added some of this to my balance portfolio. And this is like a floating rate note. So as interest rates go up, this does well. As interest rates go down, there's no more room for them to go much further lower. So we're not going to have to worry too much about negative interest rates. The Bank of Canada hasn't ruled them out, but I don't think we're going to see that. So there's a nice yield here. I think I bought, it was at 902 or something. If we have a look at the volume pattern here, you're going to see a big spike in volume. Let me see if I can put the volume on here just a few days ago. Whoa, I don't want that. Where did that come from? Pardon me. I don't want all these things. I just wanted volume. Let's get rid of all these. Wow, okay. Oh, sorry, having some trouble with my system today. So you see that right in there, it's about 3 million shares. So we bought in here, that was us. And, you know, I think 9 to 10 is probably the range we'll see. If you think the Bank of Canada is going to cut interest rates or go negative, you don't want to own this. But otherwise, I think it's a stable yielder and could be included as part of your fixed income portfolio. Okay, that was from Roger. So thanks, Roger. Next question from Frank. Can I explain real return bond ETFs and when you want to hold them and when you don't? So you have to look at they're basically the difference between and the payment that you get is a very, very small coupon plus the rate of inflation. So if the Canadian CPI or US CPI, depending on what real return you're owning, let's say the bond has a coupon of 0.5% as a coupon plus what you're going to get as an inflation rate. So if inflation's running at 2 and the coupon's 0.5, your payment's going to be 2.5. If inflation rises to 3.5, your nominal bonds are going to fall, so your yields will go up. So price falls on a nominal bond, but on a real return bond, price actually goes up because the payment's rising. Okay, so when inflation is rising, that's when you want to own real return bonds. But sometimes they're pricing in higher inflation, and that's where it gets into the break-evens. So I'm not sure. I can look them up on Bloomberg. I'm not sure where an individual investor can find the real yields and or the break-even rates. I'm not sure where the average investor can find that information. Okay, so but those are the things you need to look at. So what is the what is that bond or ETF anticipating about future inflation versus what it's actually going to be? So if it's pricing in future inflation of 2, and a year from now inflation's 1.5, well, that bond's going to sell off because the payment is not going to be equal to what it was pricing in terms of that expected inflation rate. So hopefully that answers your question there, Frank. Mark is saying with the Dow, Nasdaq, and S&P near all-time highs, and with the virus raging, I'm just looking at the latest number, 630,000 today with almost 10,000 deaths. Also with Trump, would there be a market crash like you've never seen before? So the reason the markets aren't seeing the downside volatility are a couple-fold, but the main reason is the promise by central banks to monetize debt and for governments to run massive deficits to keep the economy going. So we should see a pullback a bit, Mark, but not likely that much. I would have expected, and I did expect, Trump shenanigans post-election to cause market anxiety, and it didn't. And the main reason it didn't is because we didn't get a blue wave, and we didn't get a mandate for Biden to take the US into a socialist mode, i.e. MMT, $5 trillion in debt, given everybody universal basic income, like everything that higher taxes, wealth taxes, all that whole extreme left-wing agenda is not in play. And in all likelihood, in the midterm elections, you're going to see, if Nancy doesn't play nice here and do the right things, you're going to see the House flip over to the Republicans, and you have gridlock. So we'll see how that plays out. But yeah, those are some of my updated thoughts there, Mark, on that. I'm wondering if now's a good time to buy into the genomics and biotechnology ETF. If not, what would be a reasonable entry price? So here we're looking at ARCG. I read a lot about stem cell research and everything they're working on to grow organs, and it's just a phenomenal thing that's going to help everyone live healthier and longer. And so I'm wildly optimistic and bullish about the sector, but I'm not an expert other than to know this is going to be a winner. But when you get volatility in these things, it can be pretty substantial. So you generally want to buy dips. I'm going to just switch this to a log chart so you get, oh geez, my mouse is not playing nice on me. So you see these corrections when they happen, they can be pretty substantial from a percentage perspective. So I would say the next best buying opportunity, if you're risk averse, is sometime closer to this rising, 200-day average. If you're shorter term in nature, maybe it's the 50-day average. But if you bought it here and it goes to here, you've got to be more bullish, not less bullish, because this is a long-term trend that should be up, up, up and away. But the problem here, one of the challenges, is if you look at valuations, and so if we go and dig a little bit into it, you basically see there's no dividends, there's no PE average because most of the stocks don't have any earnings, and they're trading at 18 times sales, right? So you have an extreme valuation issue, and I don't know how to, I'm not a growth biotech guy. That's not me. So, being conservative, you want to wait for a technical pullback here of some meaningful retracement or to some level. But I like it. I like it a lot long term. And so it's a great question, but I don't have a real strong answer for you on when. I don't own any at the moment. Justin's asking in 5G, So yeah, those are all good names, the 5G, FIVG. Curiously, not Meditech. Intel recently partnered with them to produce 5G chips. Why would it be absent? Are you familiar with an ETF that might include it? MDT. So there are ADRs that you can buy for companies listed abroad: Taiwan, China, Japan, Europe, etc. So MDTKF is an ADR, and if you like that company, I know nothing about it, that you certainly play it. Why it's not included, I don't know. Okay, I don't know. Sometimes an ETF has a certain company has to been around for a while. There's a number of different criteria. I don't know why it's not included. I talked about oil and natural gas, the drillers. So yeah, Allison, I think I'm a bull there, and you want to buy into dips. The VIX has come down to 23 and gold's fallen. Is this telling us the crisis is over? Are we back to making all-time highs, or can the VIX head back to 40, 60 anytime soon? I'm not sure we see 40 to 60 on a VIX. That to me would come when there's a policy mistake. And the biggest policy mistake that governments could make, and there's a scenario here where Mitch and Nancy don't see eye to eye. Mitch doesn't want to spend enough, and the Fed backs off. And if we see that scenario play out, which I doubt, it's a 10% scenario, then the PE contracts and multiples sell off, and you get a violent sell-off in stocks, which would spike VIX up into those kind of numbers. But I don't see that playing out this year, and it's probably not a big factor until there's a policy mistake. Now, I hate the fact that valuations are absolutely insane. I really, it bothers me to no end. I've been talking about it for years, but the Fed is underwriting the market. So there actually is no fair value anymore. You can't really say that there's good value in anything today because everything's artificial. It's all boosted by central bank debt monetization. If the Fed were to back off, and at this point, some of the call is for them in the second half of next year to back off as long as there's no more stimulus needed. And then we'll see, maybe we'll get a taper tantrum. Is that going to spike VIX to 40 to 60? Probably not. You need more of an acute sell-off, something shocking, black swanish, to do that to VIX. But would volatility rise? Absolutely. To mid-30s? Sure. Right? Probably not 40 to 60, though. I have two questions. I hope I don't mind. What point do you feel you should start buying ETFs for the future? Okay, so we get a lot of questions on this. I've addressed all of these tonight. I think we have to wait for the growth names to pull back a lot, and then they're all buys again. So yeah, 10 to 20% range in there. Yes. So I've said in the past that investors like me get it wrong 30% of the time. So I listen to your advice and I've done well. Well, you're welcome. Having said that, I'm wondering what the chances of your view on gold being part of the 30%. Don't fight the Fed. View on gold being part of the 30, meaning I'm wrong on gold and gold is going to go down. That seems to be, Alvin, what you're asking here. I've stated my case for gold. Where I'm wrong is if interest rates normalize and the Fed does not put in any sort of yield curve control and they actually start raising rates. Gold, the story for gold gets crushed in that scenario. Like we saw in 20, gold was up to 1350, the Fed's raising rates, balance sheet runoff, blah, 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 blah. Gold goes back to 1200. So in that scenario, gold's back at 1600. I don't see that anytime soon. It is a risk for the second half of next year, but not in the short run. Greg is asking, I'm worried about a gold. Okay, so I've addressed gold. They're helping adding focus. Agriculture, ETF cow, would you consider? So let's have a look at cow. There's cow and there's moo, different ways to play it, but it's global agriculture. Looking, first, let's kind of give everyone a peek at what's in it from a sector perspective. So pure Aggie plays, you got the machine side, so that's going to be your deer and your caterpillars. You've got your foods, that's going to be like your Tyson meats and that. Got your chemicals, which is going to be your Monsantos. You've got your biotechs, so this is your GMO kind of players and so forth. Mostly US, a little bit Brazil and so forth. So that's where you look at them. There's the top 10 holdings. You can see your Deere and Tractor Supplies and your chemicals and your Scots. There's your Brazil, your Bunge, etc. So let's have a look at the chart. I like to look at it relative to the S&P 500 or relative to the world. So there's the picture relative to the S&P 500. It's been underperforming. It's now starting to outperform. So in an outperforming and a rising relative trend, you're buying pullbacks, throw up a moving average, buy the pullbacks. So I wouldn't chase it here. I'm not a fan of chasing breakouts. It's not my style. I'm always looking for things that are deeply oversold, relatively improving, and every time there's a dip in a relative improvement, that becomes a buying opportunity. So that's what I would look for. Let's call it something below, let's call it lower 40s. You don't want to see it break that low. So, a couple bucks lower is probably your next buying opportunity. Let's go back. Last question here, and then I'll do some of the online ones. We got the cow. Can I please comment on how the markets before the election rallied on a blue wave and expectations for large stimulus, no gridlock, and ignored potential for tax increases, now rallying? Yes, very fickle market indeed. The narrative, the discussion from day to day, depending on the media source you look at, there's always a reason for the markets to move. And, I try not to get caught up in that noise. You get caught up in the behavioral bias of recency. I try to step back from that. I mean, it is the talking point of the day, and for the bubbleheads like me on TV, you've got something to say, but you got to try to be bigger picture. You got to be thematic. You got to think out. Post-election, in almost all cases, markets tend to rally. Sometimes they sell off a bit first, but ultimately, you usually get a pretty good response post-rally. So, and then you get weakness into it. So the market backs up, anticipating bad news. The gridlock was actually probably the best outcome for the market. Initially, it was massive spending, massive Fed. That's going to be a boost for earnings, right? That was the blue wave narrative. Now it's okay, no bad left-wing agenda, no tax hikes, so that's worth something and so forth. So yeah, market's pretty fickle, and it's going to be fickle because valuations are impossible to understand given what the Fed has done, moral hazard, and so forth. So let me go to some of the online questions that have come in tonight. First question from John is saying, Larry, I own one call option contract that's in the money. Does that mean I have to buy the stock? Well, you don't have to buy it, but the idea of being in the money, there's a profit for you. So at a minimum, the day of expiration, sell it and take your profit. Now, if it's in the money by a penny, you don't have to buy it. You can call your broker, tell them not to execute your option. It's actually happened to me once. I do a lot of option writing. There was an option, it was a penny into the money, and they decided not to execute. It's the only time it's ever happened. Usually anything in the money gets automatically executed for you. So John, that's a question. It's a good question. You have the right, but not the obligation. Okay? When you're short the option, you don't have a choice. It's going to get put to you. Okay? But when you're long, you don't have to take your profit. I don't know why you wouldn't, but you don't have to. Now, if your execution costs are more than your profit, well, that would be a reason. So if you're in the money by a penny, you don't have to do it. James is asking me to have a look at XBB in respect to the corporate bond side rather than the government bond side and the duration. And he's saying the duration of the bond index, XBB is the entire bond index in Canada. So if we have a look at XBB, let me see if I can find the duration here. So the yield adjusted spread modified duration is 8.6 for XBB. And so you're saying it's 8.15. So yes, bond duration, because interest rates are low. So the lower your coupon, the higher duration. The higher that number is, the riskier fixed income is. And so that's true. That's going to be a factor for years and years and years into the future. And James is asking about corporate bonds. So you could buy, so the whole bond yield index, 1.8, entire Canadian bond market with a duration of 8.6. You can buy the XCB, that's the entire Canadian corporate bond index. You now have a yield of 2.47 with a lower duration, more yield, less risk. Now you're taking on credit risk. You don't have government bond risk, which means you have spread risk, but you have less duration. So I don't know if that answers your question, James, but thanks for that. Next question here. Recent decline in the NASDAQ, would you recommend shifting some of the holdings to the S&P 400 and S&P 600? What ETF would you recommend? Here's an interesting ETF I came across that was just launched. QQQJ. They're calling it the next generation NASDAQ 100. So the NASDAQ 100 is the top 100 names. This is the next 100 names. So Rick, I maybe that's of interest to you. But if you look at the Russell 2000 small cap stocks, IWN is an ETF that I'm getting involved with. I actually put a position in my private client ETF fund. I'll be buying it also into my growth fund. So again, broke out on the COVID news. I'm looking to buy the pullback here to the breakout. So a lot of things are breaking out. This is small cap value. And you can look at small cap value in the last few years and say, yeah, it's basically done nothing. If you look at small cap growth, IWO, so this is Russell 2000 growth, and we look at the same picture, last few years, different story. Again, growth's outperforming value. So I like value here over growth. And I would, instead of just buying the S&P 400 mid caps or small cap 600 or Russell 2000, I would tilt towards the value names, Rick. And I'm glad you're learning stuff here from these weekly webinars. Really happy about that. What is the annual investor fee? Bruce Smith is asking about. And I'm not sure what you're asking about there, Bruce. If you're talking about what we do for private clients, there is going to be a link on the email, and you can click on that link and inquire that way. Generally speaking, for portfolios of $1 million or more, the investment management fee is going to be around 1.25%. And then it goes down from there depending on the size of your portfolios. If that's something that doesn't work for you, then you can use the discount class versions of the BMO funds we run publicly, and those MERs are going to be in the 75 basis point range. Do changes in bond yields predict corresponding changes in equity markets? The 10-year has been rising. What are your thoughts? Craig's asking. So yes, so one of the ways to value equity markets is using like a dividend discount model. So the lower interest rates are, in theory, the higher the multiple can be for equities. But this is a concept called equity risk premium. So you say, well, what's the risk-free rate? What kind of return do you need to earn on equities in order to be equivalent? And the lower interest rates are, the higher that premium is for equities, the higher the multiple, the bigger growth, and so forth. So that's the concept there. Yeah, if the 10-year is going up, but it's not in a meaningful way, going from 50 basis points to 80 basis points is a rounding error. That's not going to move the nut. But if we start seeing the US 10-year rate, let me see if I can bring this chart up here. So if we go USGG 10-year, and we look at a multi-year chart here, so let's go look at a 5-year. If you go back to a 10% 3-year bond, you know, you're going to see the stock market at 2600 back then. Let's just do quickly an SPY and look at that in 2018 there as bond yields were rising. Yeah, so you've got an S&P at, 2600, 260 on the spider. If we see a 3% 10-year. So 25 basis point increase, it's not significant. You have to see a meaningful and lasting trend develop for the market to believe that it's sustainable. Okay, so it's a rising trend over a period of a year or so. And remember, the Fed starts raising interest rates, yields back up. The problem really came in here, where it broke to a new high and all of a sudden equities fell off a cliff. So you would need probably to see the 10-year get above 2 again for a re-risking, and that would be worth probably 4 or 5 multiple points on the S&P. So it's not trading at 27 times earnings, it's trading at 20 times earnings. And if earnings are going to be 170 next year, that's 3,400. At 20 times earnings. If it's 16 times earnings, because that's fair value, then you're taking off 600, 700 S&P points. All right, 2,700. Okay. Audio's cutting out, or is it just me? I don't know. Mine cut out a little bit too. It's usually Wendy. It's usually your own internet that happens. It could be the speaker sometimes. If they have a weak connection, it fades in and out too. Do you have a favorite healthcare ETF, Canada or US, or would prefer purchasing a J&J? So I talked about Pfizer. There's lots of different ways to play healthcare. biotech, pharma, so mature biotech. There's in the States, you've got a multitude. You've got hospital, you've got managed care. So under the expanding Obamacare, the Affordable Care Act, hospitals are going to do better if more money is going into them, and et cetera. Have we missed the boat? I would say no, because we're all getting older, and that's one thing we're not going to change. So healthcare management, hip replacements. So you look at Zoetis, you look at companies that are going to be providing services for the aging population. Those are going to be good names to always kind of buy on pullbacks. An active managed ETF, this Healthcare Leaders Fund, I get asked about this every week on BNN. So this is an active strategy. You look at it like that and you say, why would I want to own that? Well, you own that because it's paying you a 9% yield. And so the total return over the last 5 years is actually pretty darn good. The price return, as you can see here, is pretty crappy, but the total return, including the yield, is actually pretty good. But if you compare that to, let's say, the equal weight, Rob talked about equal weight. So BMO has an equal weight US healthcare hedged to CAD. And if you look at that, it outperformed, right? So in an up market, you don't want to own a covered call strategy. Yes, it pays you more yield, but so if you want to play healthcare right now and you want to play defensively, HHL is a great holding. If you need the yield, HHL is a great holding. But if you're bullish and you want growth, then a ZUH might be the way to go, and then you get exposure to an equal weight US healthcare. So what does that look like, ZUH? Well, let's have a look at the portfolio here, at what some of the sectors are that we're holding. So let's have a peek into here, and I've got a few minutes left before we run out of time tonight. So let me go into the sub-industry groups and see what we come up with here. So you've got 20% in biotech. You've got healthcare equipment. So that I was talking about. So you can see all that there. So healthcare equipment, Abbott Labs, Baxter, Boston Scientific. So again, Edwards Life Sciences, that's a really good company. EW, ResMed, that they make the sleep apnea devices and so forth. So Stryker, they make hips, they make stents, all these companies. In terms of the managed care, you've got a couple names there. You've got healthcare services and so forth. So lots of great ways to play it. ZUH, equal weight, get exposure to all the different sectors if you're bullish, okay? We've got time for one quick question yet. Gold stocks and why. Okay, let's do that. So I'm gonna pull up a ZGD here. And this is, again, equal weight, BMO, global gold. We're going to look at portfolio view. So this is the world of large and mid-cap names. My preference, just own the basket, get them all, right? Which ones? I like the Cadillacs. Last week I talked about the Cadillacs. Agnico Eagle is a Cadillac. Years ago, they had tremendous execution problems. They've cleaned it up. Mid-cap space, B2 Gold, Cadillac, Barrick Gold. Warren just bought into it. He's obviously done his work on that. So I don't get into these speculative juniors where they're drilling and I don't know what they're doing and I don't trust them, frankly. So buy the basket. So hopefully that that gives you some ideas, folks. Thanks again for joining us this week. I would again ask for those of you who are interested in one of our partner companies and services, if you want to look at the BMO portfolios, ZZZD portfolios, we post our weekly reports there. You can find out more about them. If you are interested in a portfolio review and a customized portfolio of what we do for clients, etfcm.com, our independent financial planning service. Without mincing words, Monique is the best. You potential. If you are a financial advisor and you are interested in working with us, have a look at our Q Wealth platform. And for the ladies out there specifically interested in, a different approach to financial markets, have a look at Golden Girls. Thanks, everybody. Please consider supporting one of our charities if you have already. Thank you very, very much. Looking forward to matching all your donations this year. Have a great week, everybody.